So today we are moving to very important lessons. So these are very important in your take-home assignment. So one is valuation of securities. Valuation of securities. We call valuation of financial assets. Right. So you have two sessions for valuation of financial assets. Session number 4 and 5. After that, we are moving to a risk and return. Risk and return lesson. Right. So that also involves more calculations. Right. So we are going to learn risk and return of one financial asset and risk and return of portfolio of assets. Right. Then capital asset pricing model. Capital asset pricing model. CAPM. Right. So all these sessions involve lots of calculations. So you should have a calculator with you now. Should have a calculator now. So there are many calculations. You have to do many calculations during these 3 hours time. So I'll be explaining each of these sessions with very simple examples. So what you have to do is, you have to work out the examples with me. You have to work out the examples with me. Right. Now let's start with the valuation of financial assets. Right. Valuation of financial assets. Right. So these financial assets are traded in financial markets. So we have an equity market. We call Colombo Stock Exchange. So in the equity market, for example, so in our stock market, Colombo Stock Exchange, mainly stocks are traded. Stock means shares. Shares of companies are traded. So shares is one financial asset, one type of a financial asset. Likewise, financial assets are traded in financial markets. Financial assets are traded in financial markets. So you can classify financial markets into a market for debt market, and equity market. Equity market. So in debt markets, debt securities are traded. For example, debentures. So in some countries, this is called bonds. Debentures or bonds. Right. Equity market. You can see stocks. So you can say shares. Shares are traded in stock markets. Right. So, trading happens between two parties. So, there's a buyer. So, buyer is willing to buy those assets. And on the other side, you see seller. Seller is the party who is willing to sell his assets. So in financial market, transactions are taking place between buyers and sellers. So market brings the buyers and sellers to one place. Right. So market facilitate meeting buyers and sellers. Right. So through the market, seller can sell its financial assets to the buyer. So market giving a facilitation. So it facilitates meeting buyers and sellers. Now, for example, you have some stocks of a company. Let's say, for example, you have some shares of a company. Now, let's say you want to sell these shares. So you are a seller. You are a seller. Right. Now you want to sell your shares. Now, when you sell your shares, you have to put a selling order. Now, let's say currently the market price of your share is 20. Let's say market price of your shares is 20 per share. Now you are thinking whether that 20 price is appropriate or not. Now you are thinking whether that price of 20 is a good price. Now what you do is you do a valuation. You do a valuation. You do a valuation and see how much your shares worth now. Right. You calculate the value per share. Right. You calculate value per share. So that is the price of a share now. So how much your share worth now? So technically we call that value per share. Now you should learn this term, intrinsic value. We call intrinsic value. Value per share. We call, you better take down, this is very important term. Intrinsic value. So you do a valuation and calculate intrinsic value of your share. Then what you do is you compare this intrinsic value with the market price. Market price. That is the price decided in the market. Now how much? In this example, market price is 20. Let's say you get an intrinsic value of 50. Now, what do you think?
Market price is overrated by
Now,
5 rupees.
is it financial? Are you financially benefited if you say?
No,
Yes.
it's a loss.
Oh, beneficial, sir.
Yeah,
Because since 5 rupees is increase, we got more than, right?
yeah. Now, my question is, are you financially benefited if you
Yes.
sell shares in the market?
Yes, sir. Because our actual value is 15, but we got 20 rupees. Mean it's 5 rupees. We are beneficial.
Yes, yes. Now you see the importance of valuation. According to your valuation, one share worth now is 50. But market gives more than 50. Now you are financially benefited if you sell shares. So that's why you need valuation. You have to see whether, as a seller, you are financially benefited if shares are sold in the market. So that's why you need a valuation. Right. Now let's think from the buyer's point of view. Now buyer is interested in buying shares of this company. So buyer also does the valuation. Now let's think from the buyer's point of view. Now let's say you are a buyer of these shares. Now before buying the shares, now the market price is 20. You have to see whether that price is a good price. So buyer also does the valuation and calculate the intrinsic value. Calculate the intrinsic value. Right. So intrinsic value is the value you arrive by doing a valuation. Now let's say intrinsic value, you got 80. Let's say intrinsic value, you got 80. Now 18 is the intrinsic value. You compare with the market price. Now market price is 20. Now as a buyer, is it worth buying these company shares?
No.
But no.
Sir. 22 rupees is loss for him.
Yes, you are paying more than you are paying 2 rupees more. Right. Now you see the application of valuation in your financial decisions. So whether you are a buyer of financial assets or seller of financial assets, so before taking buying selling decisions, you have to do a valuation. So by doing a valuation, you get the value of your financial asset, how much that asset is worth now. How much that asset is worth now. So technically we call intrinsic value. So remember, so when you are learning this lesson, you are calculating intrinsic value. You are calculating intrinsic value. Right. Then that intrinsic value, you compare with the market price. That intrinsic value, you compare with the market price. So accordingly, you can decide whether it's worth buying that shares, whether it's worth selling those shares. So those buying selling decisions you can take by comparing the intrinsic value with the market price. Right. So throughout the next 2 sessions, you are learning this valuation of different financial assets. Right. Right. So there are different valuation techniques. Right. There are different valuation techniques. That's why now seller did a valuation, that seller got value 15, but buyer got value 18. Now you see both parties have not got the same value because valuation is a subjective one. So you will learn. And there are many techniques you can apply for valuation. So technique used by the buyer will not be the same as the technique used by the seller. Because there are many techniques you can apply for the valuation. So throughout these next two sessions, we are learning few techniques. Right. So the basic technique is value equal. So value of any financial asset equal present value of that asset's future cash flows. So this is the basic technique. Intrinsic value equal present value of future cash flow. So if you can get the future cash flows of that financial asset, you know how to calculate the present value. So last time we learned that. So if you can get the future cash flows of that financial asset, then you get the present value that is equal to the value. Right. So that is the most basic technique. Now let's use this basic technique for different financial assets. Now, you know, financial assets are two types. So in the market, you have debt securities. In the debt market, you have debt securities. In the equity market, you have equity securities. Equity securities. So we will learn first valuation of debt securities. After that, we'll learn valuation of equity securities. So we are taking very few examples of securities. Right. So let's start with, now we know the valuation method, present value of future cash flows. So we'll start with valuation of debt securities. Valuation of debt securities. Right. So in companies, debt securities, right? You can see many examples: bank loans, debentures, leases, right? A more popular one is debenture. Debentures. Right. So under debt securities, we are going to learn valuation of debentures. So when you go through the financial statement, you may have seen that. Under non-current liabilities, you see debentures. In some countries, this is called bonds. Bonds. But in our country, bonds are used for government debt securities. We have treasury bonds or sovereign bonds. But for private companies, debt securities, we call debentures. We call it debentures. Right. Now we are going to apply this valuation method. So value of a debenture equal present value of its cash flows. Right. So here value of a debenture equal present value of the cash flows of the debenture. Future cash flows of the debenture. Now if you invest, now listen to me very carefully. If you invest in debentures, what are the cash flows you are getting in the future? So what's your idea? What's your idea? What are the cash flows you are getting in the future?
The interest?
Like for
Yes.
savings, the investments,
Yes.
interest.
One cash flow is interest. Very good. Now, debentures are issued for a particular time period. So it may be 5 years. It may be for 7 years. Right. Now it's better you download a listed company's annual report and see you get an idea about debentures. Right. You can download listed company's annual report from Colombo Stock Exchange website. Then you look at the company's financial statements in the annual report. You see in the statement of financial position under non-current liabilities, debentures. Then you go to the relevant notes and study about the debentures. Right. So that you have to do because you have to see practically so what these debentures are. Right. So if you invest in debentures, so one cash flows is interest. Usually debentures are issued for a particular time period. So let's think about 5-year debenture. So you invest today is 0. So in the next 5 years, you are getting interest. You are getting interest. So one cash flow is interest. Interest payments. Or you can say this coupon. Now you have to learn these terms. Coupons. Coupon or interest. Coupon. So one cash flow is coupon. Right. Some debentures have fixed interest rate. We call them fixed interest rate of debentures. So some debentures, you see a floating rate. Right. So coupon rate or interest rate can be fixed. So fixed means it is fixed. It will not be changing throughout the life of the debenture. Now, in this example, debentures are issued for 5 years. If it is issued at fixed rate, so that rate is same over the 5 years time. But if you look at annual reports of companies, you see some debentures are issued at a floating rate. Some debentures were issued at a floating rate. So floating rate means that interest rate changing. So that interest rate is changing according to a market rate. For example, let's say floating rate is treasury bond rate plus 2%. For example, treasury bills, treasury bond rates are changing. So if the treasury bond rate is 10%, how much interest you are getting from these debentures? 10% plus 2%, you are getting interest of 12%. So in the next year, if the treasury bond rate is 9%, then how much interest you are getting from these debentures?
11.
9%. Yes, 11%. Now you see the interest rate is changing. So we call it floating rate. Floating rate. Right. But when you study this lesson, usually we are focusing on fixed rate debenture, fixed rate debentures. But practically you see floating rate debentures, right? So this is one characteristic of debentures. So if you invest in debentures, you are getting periodically interest over that period. Right. Now let's say in this example, so you have invested in debentures of AB PLC. Nominal value of a debenture, let's say 1,000. Interest rate, coupon rate, let's say 10% per year. Let's say interest are paid annually. Coupon is paid annually. Debenture mature in 5 years. Mature in 5 years. Now let's think about this debenture. So your debentures, now you have invested in AB company debentures that mature in 5 years. The meaning is the debentures are issued by that company only for 5 years. So after 5 years time, company has to pay back the investors. So interest are paid at 10% annually. Then how much annual interest? How much annual interest?
100.
100. Very good. 100. Now you invest in these debentures. So nominal value of a debenture 1,000 multiplied by interest rate. Multiplied by interest rate. So first year you are getting interest coupon 100. Second year now fixed rate. Second year also 100. So if it is fixed rate, that interest rate will not be changing. Third year interest 100. Fourth year interest 100. Fifth year interest 100. So one cash flow is the coupon. One cash flow is the coupon payments. Then after 5 years time. So in 5 years, you see, debentures are matured. The meaning is company has to pay back the investors. So in 5 years time, debentures are matured. Right. So company has to pay back the nominal value. Company has to pay back the investor nominal value. So as an investor, you receive in 5 years 1,000. As an investor, you receive in 5 years 1,000. So these are the cash flows of a debenture. Now you see, there are two types of cash flows. As an investor, you are getting interest coupon. Then second cash flow is the maturity value. So in 5 years time, debentures are mature. So investor receives the nominal value. Investor receives the nominal value. Right. Now you get the total cash flows. First year cash flow, 100. Second year cash flow, you see, 100. So you get each year total cash flows. right? Now you know the cash flows. You see 50th, 1100. So you know the cash flows. Now what is the valuation model? Present value of cash flows. So you have to get the present value of cash flows. So these cash flows are discounted. So you have to take the discount factors. You can remember. You have to take the discount factors. So how do you calculate the discount factor? We learned last time. How do you calculate the discount factor? So discount factors, how do you calculate? 1 divided by 1 plus the rate R to the power n. 1 divided by 1 plus R, or you can say I to the power n. So here R means, now these are very important points. Investors expect a return. Investors required rate of return. So here R means investors required rate of return. Investors required rate of return. Right. So as an investor, you know how much minimum you need from this investment. Right. Now let's say you need at least 12% rate from this investment. So that's the your as an investor, your required rate of return. So that should be used as the discount rate. So if you know R, you can calculate the discount factors. 1 divided by 1 plus R to the power n. So how do you get the first year discount factor? We learned last time. 1 divided by 1 plus R is 12%. First year, therefore n is 1. Second year, 1 divided by 1 plus 12%. N is 2 to the power 2. Right. Now you get each year discount factor. Right. So you can calculate like this. Or you can use present value table. You can use present value table. Right. So you will see this kind of a present value table in your course material. Right. To find discount factors, you can use present value table. Right. Now your required rate of return 12%. So you go by 12% column. You see, 12% column. So in the first year, how much discount factor? 0.893. Second year, discount factor 797. So you can find the discount factors. You see, at 12% rate, first year 893. At 12% rate, second year 797. Third year 712. Fourth year 636. Fifth year 567. Right. Now take the discount factors in your calculation. 893, 797, 712, 636, 567. Right. So first year 893, 797, 712. How much fourth year? 6. How much? 6. Fourth year? 636, 567. 636, 567. Right. Now you multiply cash flow by the discount factors. You multiply cash flow by the discount factors. You are getting the present value. Present value. How much? 89.3, 79.7, 71.2, 63.6. How much? 50% value of 1100. How much?
56.7.
Yes, 56.
506.
How much? 1100 into 0.567. 623. 623.7.
123.7. Yeah.
Right. Now get the total. Get the total. You get the total. So that is intrinsic value per share. Intrinsic value per debenture.
$927.5, sir.
Yes. 927.5. Intrinsic value of a debenture. Now you see how you have done this. You got the cash flows. You see, you got the cash flows. For debentures, there are two cash flows. The periodic interest payment or coupon on and nominal value at the maturity. Then these cash flows are discounted by, remember, investors' required rate of return. Right. Required rate of return. Right. Investors' required rate of return. In other words, this is called yield to maturity. Now you should take down. So discount rate is yield to maturity. Yield to maturity. In simple terms, that is the rate you expect or you need by investing in these debentures. Right. So we call it technically yield to maturity. The rate of return that you need, we call required return, by investing in these debentures. Right. So more technical term is yield to maturity. Right. So in this example, we have taken yield to maturity 12%. So in the next lesson, you will learn how to calculate this. Right. So we have a lesson risk and return. So you will learn how to calculate this. How to calculate the investor's required return. So investors expect a return. You are going to learn that. So in this example, we have taken 12%. So you got the discount factors at 12%. Then cash flows multiplied by the discount factors. So you got present value. So total of the present values is the value of a debenture. So technically we call intrinsic value. We call intrinsic value. Right. So this is the how you apply this valuation model. You see, valuation is value equal present value of future cash flows. Right. Now let's take another example. Right. Now let's say you are considering an investment in preference shares of X5 PLC. Let's say you are considering an investment in preference shares of X5 PLC. Let's say that those shares give annual dividend of 50. Annual dividend, for shares, you are getting dividend. Let's say a company gives 50 annual dividend per share, and these shares are redeemed. These shares are redeemed in 4 years. At the redemption, investors are getting, let's say, 500 per share, 400 per share. Now you see, company has issued preference shares only for 4 years. So redeem means company pay back the investors in 4 years' time. We call redemption. Company pay back the investors. We call redemption. So like debentures. Now you see debentures are matured in 5 years. So in 5 years, company pay back the investors. So similarly, these preference shares are redeemed in 4 years. Let's say investors require return, required rate of return. Let's say 10% per annum. 10% per annum. Right. Now let's see this example. Right. So you are considering investment in this company preference shares. How much intrinsic value per share? How do you calculate? You apply that model. So what is the valuation model? Value equal, you see, intrinsic value equal present value of future cash flows. So first identify future cash flows. Now what are the future cash flows? You see, shares are redeemed in 4 years. So cash flows are for next 4 years. Cash flows are for next 4 years. Now what are the cash flows?
Dividend.
Yes, very good. As an investor, you get dividend annually. So one cash flow is dividend. One cash flow is dividend. You see, annually, you get 50 dividend. Annually, you get 50 dividend. Any other cash flow? Any other cash flow?
Yeah, when you redeem, you're getting the 400 per share.
Yes, very good. So at the redemption time, you see shares are redeemed in 4 years. Then at the end of the 4th year, you get the redemption value. You get the redemption value. You see redemption value 400. Now these are the future cash flows. You see first year cash flow 50, second year cash flow 50, third year cash flow 50, but the 4th year 450. Right. Now you know the cash flow. So how do you get the value? You get the present value of these cash flows. So what you do is you discount these cash flows by discount factors. So you have to take discount factors. So what is the rate you apply for discount factors? Investors require return. You see,
10%.
10%. You get the discount factors at 10%. You can follow the discount factor table, present value table. So you go by 10% column, 10% rate. You see 10% rate here, 10% rate. So first year discount factor 909. Second year 826. Third year 751. Fourth year 683. 909, 826, 751, 683. Right. So discount factors 909, 826, 751. Is it 683? Fourth year?
Yes, sir, 680.
Right. Now multiply cash flow by discount factors. You get the present value of cash flows. You get the present value of cash flows. How much? 15 to 909. How much?
First year 45.4.
Yes, 45.4. Then 15 to 826. 15 to 751.
41.3.
Yes, 41.3. 15 to 751. 3755. 415 to 683.
4 point,
307 point.
no,
How much?
307.35.
35. Now get the total. Get the total of the present values. How much? 431.65.
Yes, sir.
Right. So this is intrinsic value of a preference share. Intrinsic value of a preference share. 431, almost 432. So this is the value of a share worth now. Let's say company issues at 450. Let's say company issues these shares at 450. Would you buy?
No, sir.
No, because shares are worth now 431. per share according to your valuation. But company issues at a higher price. So as an investor, it is not worth investing in these shares. Right. Now you see, once you get the valuation, you compare with the market price or price offered by the company. If it is a new issue, then see whether it is worth investing in these shares. Right. Any questions?
No, sir, perfectly clear.
Right. How about others? Any question?
No.
Right. Now let's see. Now we have studied valuation of some debt securities. Let's see valuation of equity. Valuation of equity shares. Valuation of equity shares. So equity shares we call common shares. Or you can say equity stock or common stock. Equity shares or common shares or equity stocks. Common stocks. Right. So these are alternative terms we are usually using.
Excuse me. So then all these equity shares, is it a addition of the ordinary shares and the preference shares?
No, this is also ordinary shares. Equity shares, or you can say another term, very good. Ordinary shares. Ordinary shares. Shares are usually two types. One is equity shares.
And
The
the
other one
preference.
is right. For equity shares, we have alternative terms. Ordinary shares, common shares. Or you can use the term stocks. Equity stocks, common stock. Right. Shares are two types. Preference shares and ordinary shares. This is ordinary shares. Right? Right. Now here also we can apply this model. Now what is the model? Value per share equal or intrinsic value equal present value of future cash flows. Present value of future cash flows. Now let's say, for example, let's say you are considering investment in AB company equity shares. Let's say you are considering investment in AB company equity shares. Now you are going to do a valuation, right? So as an investor, you have to do it. So rather following the friends' decisions, right? Rather ad hocly take the decisions. So you have to do a analysis and take a decision. That's why you are going to learn this, right? Sometimes you see you may have seen your friends are following the others' decisions. We call herding. That's not a good practice, right? Sometimes you follow news, financial news, and suddenly you decide to invest in that company. That's also kind of a herding. So you have to avoid such practices. There are situations such practices give you financial benefits, but not every time. So you have to do an analysis and take a decision. So one analysis is the valuation. Right now, in this example, let's say you are considering investment in this company equity shares. Now you are going to do a valuation. You are going to apply, let's say, that valuation model. What is the model? Value equal, intrinsic value equal, Present value of
Present value of
future
cash flow of future.
Yes. Present value of future cash flows. Now, what are the future cash flows? If you invest in these companies' equity shares, what are the future cash flows?
Interest.
Interest. Now, interest for bonds, debentures, but shares.
Share dividends.
Dividend.
Dividend.
Right. So your cash flow is dividend. Right. Now, let's say you are planning to invest only for the next year. Right. Now, this is very simple situation. You are planning to invest only for the next year. Right. Then what are the cash flows? Next year you get the dividend. So one cash flow is dividend.
And redeem value?
Redemption of the share.
Yes. So one cash flow is dividend. Then at the end of the next year, you are going to sell the shares. Another cash flow is sales value. Sales value of that share. Right. Selling price. Let's say it's selling price. So you have two cash flows. So next year, now you are planning to invest only for next year. So next year you are getting dividend. Then at the end of the next year, you are going to sell the shares. So you get the selling price. Right. So you have to get these two cash flows. But it's not easy like preference shares. This is very important point. So in preference shares, you know the dividend. Because this is fixed. In preference shares, amount of the dividend is fixed. It is given at the time of issuing the shares. In preference shares, redemption value fixed. But for equity shares, these two are not fixed. So
Floating.
dividend vary. Yes. Yes, you can ask.
It must be a floating value, sir?
Yes, it's vary. It's vary from year to year. For equity shares, dividends are paid only company has enough profits.
Okay. Got it.
Not like preference shares. Preference shares, dividend fixed. At the time of issuing the shares, company says annual dividend is 10. That is fixed for the entire period. But equity shares, dividends are paid when the company has enough profits. Dividends are paid when the company has good cash flow position. But for example, if the company facing liquidity issues, cash flow issues, then company may decide not to pay dividend. Right? So equity shares, dividend vary from year to year. Now, how much next year dividend? You have to forecast. You have to forecast. That's challenging. Right? This is challenging. So equity shares, cash flows, you have to forecast. But if you look at the valuation of debentures, do you need to forecast cash flows?
No need.
No need. Because they are given. Interest rate given. It is fixed. If it is fixed, you simply multiply nominal value by the interest rate, coupon rate, you get the annual coupon. Then at the maturity, investors are paid the nominal value. That's also given. Preference share also the same. Dividend is given and the redemption value is given. But for equity shares, these values are not given. They vary depending on the market conditions. They vary depending on the economic environment. Right? You have to forecast. You have to forecast. That's why equity valuation of equity shares is a challenging one. So you have to forecast future cash flows. So you need more information to do that. So you should learn the forecasting techniques. Right? Now, for example, let's say last year this company paid dividend of 20 per share. So you may forecast next year company pay 25. Sometimes you may forecast next year company would pay the same dividend as the last year. So these two, when you value equity shares, you have to forecast. You have to forecast. Now in this example, let's say company will pay next year, you forecast company would pay 20 rupees of dividend. Let's say according to your forecast, next year dividend 20 rupees. Then let's say according to your forecast, you could sell the shares of this company at the end of the next year, let's say for a value of 250. 250. So these are your forecasts. Now value per share is 220, for example. You expect the price will go up to 250 by the end of the next year. So that's your forecast. Then next year, total cash flow, end of the next year, total cash flow 270. Then how do you get the today value? Now you know the future cash flow. Next year cash flow is 270. So how do you get the value of a share? You get the present value. You multiply it by discount factors. You multiply it by discount factors. Let's say your required rate of return is 10%. So you take the next year. Now this is year one. Next year discount factor at 10%. How much? First year discount factor at 10%. We got earlier. How much? 909. 909. Right. So cash flow multiplied by discount factor, you get the present value of cash flow. How much? How much? Value per share now?
43.
Yes, 245.43. Right. So value per share or intrinsic value 245.43. Right. So you can apply the same technique. Now, what is the valuation technique? Value equal present value of future cash flows. But when it comes to equity shares, you need to forecast cash flows. You need to forecast cash flows. Now here your intention is keep the shares for only for next year. So here your intention is to keep the investment in this share only for the next year. Now let's say your intention is to keep the shares for next 3 years. Then how do you do the valuation? How we are going to do the valuation? Your intention is to invest in this company ABPLC equity shares for next 3 years. Then how do you do the valuation? You have to take the cash flow for next 3 years. First year, second year, third year. Because your intention is to do the investment for next 3 years. Your investment period is 3 years. So you have to take the cash flows for next 3 years. So you have to forecast dividend for next 3 years. You have to forecast the selling price of the shares for next at the end of the third year. Now let's say you forecast dividend, next year company would pay 20. In the following year, company would pay 22. Let's say these are the forecasts. After that, company would pay 25. So this is your forecast dividend. Let's say your forecast is at the end of the third year, you can sell this company shares at a price of 280. Now we have the future cash flows. Then how do you get the value? You take the total of future cash flows. Total of future cash flows. You see third year, 305. Then how do you get the value? These future cash flows are discounted. Let's say your required rate of return. So remember, every time when you discount the cash flows, you have to apply your required rate of return. That is the rate of return you expect. That is the rate of return you need at minimum from this investment. Let's say that's 10%. So you take the discount factors at 10%. So what are the discount factors? First year, 909,
826,
826,
751.
751. Then cash flows multiplied by discount factors, you get the present value of cash flows. Now you get the present value of cash flows. How much? 20 into 909. How much?
18.18. 18.18.
18.18. Then 22 into 826. 18.17. Then 305 into 751. 229.06. Then intrinsic value equal total of these present value of future cash flows. Intrinsic value equal the total of these present value. How much? How much? How much total?
265.412.
Yes. 265.41.
Yeah.
Right. So that's value of a share worth now. That's value of a share worth now. Then how do you take the investment decision? How do you take the investment decision? You compare this with the market price. You compare this with the market price. Now let's say market price is 252. Is it worth investing in these shares? Is it worth? What do you think?
No.
Is it? Now you think very carefully. One share worth now 265, but those shares are available in the market at the price of 252.
Available. Then okay, then it's beneficial.
Yes, you can buy at 252. That price lower than your valuation. Then it's profitable to buy. It's worth buying these shares. Right. Now you see, for equity shares, you can apply the same technique.
So excuse me,
But
this
yes,
forecasting can we do according to our assumptions
yes,
forecasting?
yes. When you do the forecasting, very good. You have to use some assumptions. Forecasting is based on assumption. Right. Yes, you have to apply assumption. But developing a set of assumptions is a challenge. You have to assume some variables in the economic environment like interest rate, inflation rate. Right. So developing that set of assumption is a challenge. Right. So you need some experience. You need some experience. There are techniques you can apply to develop those assumptions. Right. So that's a separate area. Now here, we are going to learn the valuation part only. Right. Now, let's say the same example. Same example. Now, let's say you are considering investment in this company, equity shares. So you have intention to keep the shares for a very long time period. Till you have not decided, you are going to keep only for next 5 years. Right? Next 2 years. Let's say your intention is to do a long-term investment. So when it comes to investment decision, long-term means not more than 1 year. So in accounting, when you say long-term, you usually use more than 1 year. When you classify non-current asset, you are applying that period more than 1 year. But when it comes to investment decisions, long-term means not more than 1 year. Usual long-term means more than 5 years time. Short-term is 1 to 2 years time. Right. Now let's say your intention is to invest in this company, right? You are considering investment in this company. And your intention is to do that investment for a long time period. Right. So your intention is to do a long-term investment. Long-term investment. So you will definitely keep shares of this company more than 5 years time. Right. So when you develop forecast, it's very difficult to develop forecast beyond 5 years. You can develop forecast usually up to 5 years time. So beyond that period, even you cannot imagine how economic environment would be after 5 years time. How technological, social, cultural environment would be after 5 years time. It's very difficult to forecast. Right. So that kind of forecast you cannot make beyond 5 years time. It's very difficult. So in such a situation, you should develop assumption about the pattern of the dividend payment of the company. The pattern of the dividend payment of the company. So you can observe last year's dividend payment pattern. So if the company continuously increased dividends over the last years, you can expect that pattern would continue for a long time period. Right. Now, for example, now this is very important. You should listen to me very carefully. Right. For example, let's say over the last 5 years, let's say over the last 5 years. Now let's take the years, last 5 years. Year 2023, year 2024, 22, year 2021, year 2020, and 2019. Let's say over the last 5 years, these are the dividend payments by that company. Let's say 2019 dividend for a share 10, 20, 12, 21, 15, 22 dividend per share, let's say 18, 23, 20. Now let's say this is company's dividend per share over the last 5 years. Over the last 5 years. Now you observe the pattern of dividend payment. You observe the pattern of dividend payment. You see, over the year, company has increased the dividend per share. So you can expect that pattern would continue for a long time period. You can expect that pattern would continue for a long time period. Right. Now remember, when you do the equity valuation, you can do forecasts like this, usually up to 5 years. Beyond 5 years, the forecasting is really difficult. You cannot actually think about what would happen after 5 years. It's not possible. So in such a case, this is what you can apply. You observe the last year's dividend payment pattern. Accordingly, you develop an assumption about the company's dividend payment pattern. Now, in this example, you see last year, company has been increasing the dividend from 1 year to the next year. Now, you are listening to me very carefully. This is very important. So you can assume over the next years, for a long time period, company would continue the same pattern. Now calculate annual growth rate of dividend from 19 to 20, 19 to 20. What is the growth rate in the dividend? 10 increase to 12. What is the growth rate?
2.
Yes, dividend increased by 2 as a percentage. Dividend increased by 2 from 10 as a percentage.
0.2.
Yes, 20%. Or 0.02. Sorry, 0.2. 0.2. 20% or 0.2. We call growth rate. How about 2020-21? 2021. 12 increased to 15. 12 increased to 15. So dividend increases by 3 from 12. So what is the rate? Rate of increase? 3 divided by 12. 0.25.
0.2.
Yes. From 21 to 22, dividend increased by 3 from 15 as a rate 3 divided by 15. 3 divided by 15, how much? How much? Point?
0.2.
Yes, 0.2. Then 2020, 22, 23.
0.1.
Yes, dividend increased by 12 from 18. 0.11, 0.11. How much average growth? Average growth?
The total of all should be divided by 4.
Yes, you take the total annual growth rate. So this is annual growth rate. This is annual growth rate. Now you have to work out the question with me. Work out this example with me. This is really important. This is annual growth rate. Annual growth rate, you take the total.
The average growth rate 0.1.
Yes, total is 0.76 divided by 4. 0.19. The average growth rate. So this is average growth rate. Average growth rate. Average dividend growth rate. 0.19. So this is simple average. Simple average. Or you can get the geometric average. Right. So you may have learned in the statistics, mathematics, average you can take as simple average or geometric average. So if you take geometric average, so this is how you get the average. You take the last dividend divided by, now you have 5 years dividend. You take the last dividend divided by earliest dividend 10. You see earliest dividend is 10. Square root 10. Square root 10. So n is number of periods you have considered. You have considered from 1920, 2021, 21 to 22, 22 to 23. So how many periods you consider? 1, 2, 3, 4. So one is 19 to 20. Second one, 20 to 21. Third one, 21 to 22. Fourth one, 22 to 23. So how many periods you consider? 4. Square root 4. Square root 4. See how much? How much? So with your scientific calculators, you can take how much? How much? 20 divided by 10, square root 4. How much? How much? You get 1 point.
0.656.
Square root 4. 1 point.
5 point. So
189. 1.189. Have you got this answer? Have you got this answer? 1.189. Right. Then deduct 1. Now from this answer, you deduct 1. So growth rate 0.189. 0.189. Now you see these two are very close. Simple average 0.19. Geometric average 0.189. So you can say the close answer is 0.19. 0.19. So these two are very close. There would be a very small difference. Right. So you can calculate the growth if the company has continuously increased the dividend payment. You can calculate the last past growth rate and assume that will be continued in the future. So next year, 2024, following year, 2025, after that 2026. So you assume that growth rate would continue for a long time period. So growth rate is 0.19, 19%. So your assumption is company would increase dividend payment annually by 19%. Company would increase the dividend payment annually by 19%. Right. Now you can calculate the future dividend applying 19% rate. Right. How much next year dividend? How much 2024 dividend? Now dividend increases at 19%. Last year dividend 20. So this increases by 19%. Then 20 multiplied by 1 plus growth rate. 1 plus growth rate. So how much next year dividend? Last year dividend 20, that increases by 19%. Next year dividend, how much? 23.8. 23.8. 23.8. 2025 dividend, how much? 2024 dividend 23.8 increases by 19%. Multiplied by 1 plus 19%. How much? 2024 dividend, how much? 28.32. 28.3. Then 2026 dividend. Last year dividend 2025 28.3 increases by 19%. 1 plus growth rate 19%. How much? 33.7. 33.7. So likewise, that would continue for an infinite period. Right. That would continue for a very long period. Because your intention is to keep the investment for a long period. So this dividend pattern would continue for a long period. So it could be 30, 40 years. Right. It could be a very long period. Right. Are you clear with the idea? If you are making a short-term investment or medium-term investment, you can forecast the dividend like this. You can forecast the dividend like this. And calculate the value per share. If it is long-term, you have to develop assumption about company's dividend pattern. Now here assumption is, you see, you observe the past dividend. You observe the past dividend. So you have seen over the last years, company has continuously increased the dividend. So this is one
So,
example. Yes,
in case now we'll think due to the pandemic, the dividend per share was reduced from
yes,
2020 to 2021. We think
yes,
it became like once again 1009. So
yes.
then the pattern of the growth will be changed, right?
Yeah, but practically those unusual years we try to neglect. We try to
Right.
avoid. Right.
Okay, sure.
So
Thank
when you observe the pattern now, especially 2019, 20, those are not usual years. Right. But after the pandemic, you can see whether company has started to continue that pattern or not. Right. You have to study the data. Sometimes 2019, 2021, company has decreased the dividend. But depending on the current situation and according to the company's management expectations, now you have to see other details also, the management future plans, right? Management strategies. So those are available in the annual report, right? So you have to study those strategies of the company. And based on that, you can SEO, you can think whether company would continue increasing the amount of dividend. You can make some judgments, right? So remember this, these calculations are highly subjective, right? That based on your judgments about the company's future, right? So when there are unusual years, that's very good point. Usually when you are doing the analysis, those years you try to avoid, or you try to do some adjustments to those years and try to make it usual. There are two things you can do. You can avoid those years, or you do some adjustment to make it usual, right? There are some techniques you can use, right? Now what you did was, you observe the last dividend. So you have seen company has been continuously increased the amount of dividend per share. Then you can assume that pattern would continue for a long period, right? That pattern would be continue for a long period. Now you have to develop an assumption about company's dividend payment pattern. Right. Now here assumption is company would continuously increase the dividend at the rate of 19%. Right. So amount dividend per share in the future increases by 19% for a very long time period. So if the pattern is this, to get the present value of future dividend. Now what are the future dividend? Next year, 23.8. Following year, 28.3. After that, 33.7. After that, so you can continuously increase the dividend by 19%. So if the pattern is like this, you can apply dividend growth model. Dividend growth model to get the value per share, intrinsic value per share. So it says price equal, price now equal. So price now means value per share now, intrinsic value per share now, intrinsic value per share now, equal D1 next year dividend divided by investors' required rate of return minus growth rate. Right. So if the dividend pattern is like this, now what is the pattern? What is your assumption? Company would continue to pay dividend, or company would continue to increase the dividend at the rate of 19%. So future dividend will increase at a particular rate. You see, rate is 19%. So if the pattern is like this, you can apply the dividend growth model to get the present value per share. Sorry, present value of future dividend. Now our valuation technique is value per share equal present value of future cash flows. Right? Now to get the present value of future dividend, you can apply the growth model. You can apply the growth model. Right. So let's apply now. How much next year dividend? So next year is 2024. How much dividend?
23.9.
23.8. So D1. So D1 is next year dividend. 23.8. Assume investors require rate of return 25%. 0.25. Growth rate 19%. Then how much? Value per share. How much value per share? 23.8 divided by 0.25 minus 0.19. 23.8 divided by 0.25 minus 0.19. How much? How much? Rupees?
5.0. No.
396.67. Have you got the answer? Have you got the answer?
Sir, can you explain it again?
So which one?
Last
Which
part.
Now this is a dividend growth model. Are you clear with that?
No.
Right. So in the growth model, D1 is next year dividend. Next year dividend. So you can take down. D1 is next year dividend. K means investors require rate of return. Now you can remember, every time to discount the cash flows, we apply the required rate of return. So that's K. K means investors required return. G is dividend growth rate. Dividend growth rate.
Yes, sir. Got the answer. 396.67.
Yes, 396.67. Now, if the dividend pattern is like this, so if you assume that the dividend will continuously increase at the rate of 19%, so if the dividend is expected to increase at a particular rate, you can apply the growth model to get the present value of future dividend. Right. Now you see present value of future dividend, 396.67. So that's equal to value per share. That's equal to value per share. Right. Intrinsic value per share. Any questions?
No, sir.
Let's assume another situation. Now let's think about another example. Example 2. Let's say you are considering investment in equity shares of XY PLC. Right. Let's say you are considering a long-term investment. Right. So long-term means beyond 5 years. That investment will continue more than 5 years. Let's say your assumption is company would pay dividend per share, let's say in the next year. So 1 means next year. 10 rupees of dividend per share. In the following year, in 2 years' time, 15. In 3 years' time, let's say 18. After that, dividend increases at the rate of 5%. From the 4th year onwards, so this is your assumption. This is your assumption about the pattern of dividend, right? So assumption is next year company would pay 10 rupees of dividend per share. After that, 15 rupees. After that, 18 rupees. From the 4th year onwards, company would increase the dividend by 5%. Dividend will grow by at the rate of 5% per year. Now let's take this is as assumption of company's dividend pattern, dividend payment pattern in the future. So that's your assumption as an investor. Other investors may have different assumptions. So your assumption is in the next 3 years, company would pay dividend like this, 10, 15, 18. After that, the dividend grow by 5% at the rate of 5% per year. Let's say your required rate of return, KE, 10%. 10%. So how much is the present value of dividend? How much is the present value of dividend? You see, in the first 3 years, you have forecasted amount of dividend. You know, for a short term, medium term, you can do forecasting the dividend. Right. Now you see, for the first 3 years, you have forecast the dividend per share. Now you can get the present value. First 3 years, you know the dividend, you know the cash flow. First 3 years, you know the cash flow. First year dividend 10. Second year dividend 15. Third year dividend 18. Now can you get the present value? So how do you get the present value? Cash flow multiplied by discount factors. So what is the rate you can use for discount factors? You see, investors require rate of return, KE, 10%. So you take the discount factors at 10%. How much? First year discount factor, 909. Second year, 826. Third year, 751. So cash flow multiplied by discount factor, you get the present value. How much? 9.09. Second year present value, 15 into 286. Sorry, 826. How much? 12.39. Third year, 18 into 751. How much? 13.52. Now these are the present value of next 3 years dividend. After that, now you see, after that, dividend grow by at a fixed rate, 5%. So after that, situation is like this, like our previous example. Dividend grow at a particular rate. Now you see in the previous example, dividend grow by 19%. So in this example, from the fourth year onwards, dividend grow by 5%. So when the dividend grow by at a particular rate, you can apply this model, dividend growth model, to get the present value of the dividend. To get the present value of the dividend. Now listen to me very carefully. So here, dividend grow by 5% from the fourth year onwards. Now listen to me very carefully. So in this example, dividend grow by 5% from the fourth year onwards. Then you can take value of O2, the present value of dividend from the fourth year onwards by applying the growth model. But you are getting the value not now. You are getting the value at the end of the third year. Now you see again. So here, first 3 years dividend, you have forecasted. Now you see this very carefully. From the fourth year onwards, dividend grow by 5%. So this happens from the fourth year onwards. So here you apply the dividend growth model. You apply the dividend growth model. So you apply the growth model only for dividend from the fourth year onwards. Fifth year, fourth year, fifth year, sixth year, seventh year. So you apply this model only for the dividend from the fourth year onwards. So you get the p-value. So how do you get the p-value? D1 divided by Ke minus G. So you apply this model only for dividend from the fourth year onwards. So you get the p-value. This p-value is the value at the end of the third year. Have you got the point? Have you got the point? Now let's look at the previous example. So in the previous example, now you have listened to me very carefully. This is very important point. In the previous example, you assume dividend grow by 19% now onwards. So today 0, From the first year onwards, dividend grow by 19%. First year means next year. Second year means in 2 years' time. You see, next year, 2024. You see? Then 2025, that is second year. Third year, 2023. Sorry, 26. So 19% dividend growth you assume from first year onwards. Then you apply the growth model. So what is the growth model? P equal D1 divided by A minus G. From the dividend, for the dividend from first year onwards. Then you get the P value now. Value now. But here, your assumption is dividend grew at a particular rate from the fourth year onwards. Then you apply, yes, you apply growth model only for the dividend from the fourth year onwards. Then P value is not value now, value at the end of the third year. Have you got the point?
Yes, sir.
Yes.
This is very important. You should understand. So here dividend grew at a particular rate, 5%, from the fourth year onwards. Then you can apply the growth model and get the P value. But P value is not value at 0, not value now. That is the value at the end of the third year. Right. Now you can get the value of the rest of the dividend, end of third year value of the rest of the dividend. So rest of the dividend means dividend from fourth year onwards by applying the growth model. By applying the growth model. Right. Now apply the growth model and get the P value. D1 divided by K minus G. D1 divided by K minus G. How much D1? So D1 is next year dividend. Now we are at the end of year 3. From end of year 3, what is next year?
Fourth year, 5%.
Fourth year. How much fourth year dividend? How much fourth year dividend?
5% it's increasing.
Yes. Last year dividend 18, you see? Third year dividend 18. Then D1. So here D1 means it's better to put D4. Fourth year dividend. Because we are at the end of year 3. So D1 is the next year dividend. That should be the fourth year. So how much D4? 18 into
18 into 5%.
1.05. Yes, 18 increases by 5%. How much? D1? How much? 18 increases by 5%. 18.9.
9.
Yes. So D1. So next year dividend D4, 18.9 divided by KE minus G. So we know KE 10%, growth rate 5%. Growth rate 5%. So 18.9 divided by 0.1 minus 0.5. How much? How much? Is it 378? Have we got 378? Have we got 378?
Yes. Yes.
Right. So these are the values of dividend from fourth year onwards. Now we apply the, you see here very carefully, we apply the growth model for the dividend from fourth year onwards. So discounted value of dividend from the fourth year onwards is 378. So that is the discounted value of the dividend from fourth year onwards, the value at the end of the third year. So discounted value of the dividend from the fourth year onwards at the end of third year is 378. Right. So end of the third year value, 378. So this is dividend from fourth year onwards. Right. So dividend from fourth year onwards we have taken and discounted. The discounted value of this dividend at the end of the third year, 378. Now you have to get it to the today's value. So you have to get it or discount back to the today's value. Now we have the end of the third year value, 378. You multiply it by third year discount factor. So when you multiply this by third year discount factor, you get the today value. You get the present value, today value. Right. So multiply this by third year discount factor. You get the today value. How much? 378 multiplied by 751.
283.88.
Yes. 283.88. So this example is very important. You have to study very carefully. You listen to my instructions. You see the recording again. You follow the recording and listen to my instruction very carefully. Try to understand this. Right. Now you can get the total of the present values. You can get the total of the present values. How much? Total of the present values. How much? Is it 380?
318.88. Yes, sir.
80. So this is intrinsic value per share. Intrinsic value per share. Right. So intrinsic value per share. Any questions?
Sir, can you explain again the third year, how we get the third year 378?
Yes. Now here, first 3 year dividends we have forecasted. Right. Now you see again, First 3 years dividend we have forecasted. Then question assumes dividend grow by 5% per year from the fourth year onwards. From the fourth year onwards, dividend grow by 5% per year. Then you can apply the growth model from the fourth year onwards. You can apply the growth model. So what is the growth model? P
equals to D1 divided by KE minus
G. So this model is applicable in this example for the dividend from fourth year onwards. Right. Now how much fourth year dividend? Now here D1 means now fourth year dividend. How much fourth year dividend? Third year dividend is 18. That increases by 5%. So 18 is the third year dividend. That increases by 5%. Divided by KE, 10% growth rate, 5%. So value is 378. Is it clear?
Yes.
So that value, now this is the important point. Now here we have used dividend from the fourth year onwards only. So this P is value at the end of the third year. This value is at the end of the third year. So discounted value of dividend, now listen to me very carefully. 378 is discounted value of dividend from the fourth year onwards. Discounted value of dividend from the fourth year onwards. Right. So that value is end of third year value. Now you need this value now. Now is 0. Now you have to again discount that to today's value. So this is end of third year value. So 378 multiplied by third year discount factor. So what is third year discount factor? 0.751. Then you get value of this dividend now. Value of this dividend now, 283.
3.878. So 88. Yeah.
Right. Are you clear now?
Yes, sir. Perfectly. Perfectly.
Right. Right. Now let's look at, right. So before moving to the next lesson, let's see your assignment. Take home assignment. Right. Because these valuations you have to apply in the assignment. Right. So you have to follow the policy for take home assignment that will be uploaded in your LMS. Right. Deadline 15. Right. First part, you have to study and discuss. Right. You have to have a study. Right. In the second part, you have that valuation. Right. Now you have 5 companies, dividend per share, current stock price, and earnings. Last 5 years, earnings per share. Right. Then you see a treasury bond rate, market return. Right. So first question is, you calculate the required rate of return, KE. Now listen to me. In our examples, KE is given. In all our previous example, K is given. You can remember, required rate of return for bond valuation, we got 12%. Then we got 10%. Required rate of return given. But there are techniques you can apply to get the KE value, required rate of return. Investors require rate of return. One technique is capital asset pricing model. Right. Now, in our valuation examples, you know the required rate of return. You should know it. So why do you need that required rate of return in your valuation? Why do you need that?
For the investor purpose, right?
Yes. Are you going to apply that when you do the valuation? At which point you apply the required rate of return?
To redemption, right? Sir? When they
No, you should look at the previous example. At which point you apply the required rate of return? Look at the previous example.
Even when calculating the growth model.
Yes, one is when calculating the growth model. Very good. In the previous example, debenture valuation, preference share valuation. So where have you applied the required rate of return? At which point you apply it? Now this is how you learn, right? You look at the previous example. It's very good. You should answer me, right? At which point you apply the required rate of return?
When calculating present value?
Yes, very good. When calculating the present value. Right. Because our valuation technique is value equal, intrinsic value equal, present value of future cash flows. That is the valuation technique. Now, once you know the cash flows, you have to get the present value. How do you get the present value? Cash flow multiplied by discount factors. You can remember. Present value is cash flow multiplied by discount factors. Now you see, present value is, in the last example, you see, cash flow multiplied by discount factors. To get the discount factors, you should know KE. You should know KE. In the previous example, this preference share valuation, to get the discount factors, you should know investors require return. In the bond valuation, to get the discount factors, you should know the investors require return, 12%. We call it yield to maturity. Investors require rate of return. In the bond valuation, debenture valuation, we call yield to maturity. Right. So when you do valuation, you should know the investors require rate of return. Right. In our previous example, it's given. But there are techniques you can use to calculate it. So one technique is capital asset pricing model. One technique is capital asset pricing model. So in your assignment, you have to apply that model and calculate investors' required rate of return. Investors' required rate of return. Right. Now let's have a study on capital asset pricing model, because that is very important in your assignment. Now it says, now you can go through this, right? These theoretical aspects you can go through, right? So this is model. This is model. This is model. Right. So it says investors require return or expect a return. So this is expect a return or require return. Investors require return or expect a return. Right. You can say ER expect a return, or you can use require return. A equal risk-free rate plus beta multiplied by difference between market rate and risk-free rate. Right. So I'll simplify this. Right. So investors' required rate of return is equal to K equal to risk-free rate plus beta times. So I'm going to explain each of these. Market rate, market return, minus risk-free rate. So here risk-free rate means there are assets, securities. We assume risk is free. So theoretically, government securities are risk-free. But practically, you can experience over the last year, it is also risk. Because theoretically, we assume government will not bankrupt. Therefore, government securities are risk-free. But practically, we all experience there's a risk involved in government securities. But theoretically, we assume government securities are risk-free. So risk-free rate is the rate of return for government securities. Plus beta. Beta is the market risk of the company. Market risk of the company. The market risk of the company multiplied by market return minus risk-free return. So in the assignment, those are given, right? You don't have to worry about it. Those are given. You see, treasury bond rate, it's given, right? So what is that now? What is that? In the model, where are you going to apply that?
This one is a risk-free rate, right?
Right. Market return given. Beta values are given. Right? Now you can apply these beta values of each company and answer the first question. Because I can't explain the answer, I'm just giving the guidance.
We got
Right.
the idea, sir. Thank you so much.
Right. Then you see part C. You have to calculate the intrinsic price. Right?
Above stocks.
Based on, you see, intrinsic price. You see, investors expect past trends of earnings to continue and growth based on earnings growth rate. So investors expect dividend would grow. To get the growth rate, you apply the earnings growth rate. You see, last 5-year earnings are given. Now, can you calculate the growth rate? Can you calculate the growth rate for each company? We studied one example.
Yes, I can, sir.
Right. So we can calculate a simple average.
Mhm.
or geometric average. The more appropriate one is the geometric average. Right. So we have given here not dividend per share, earnings per share. But question says the growth rate is based on earnings growth rate. So by taking the growth rate of earnings, you can take the earnings growth rate that you can assume as equal to dividend growth rate. Right. So you can apply the geometric average. We study one example and calculate the growth rate. Then you can get the value per share by applying the dividend growth model. Right. So all information here. Right. All information here. So here what I wanted to highlight is to calculate the growth rate, the question says you have to apply the earnings. You have to use earnings growth rate as dividend growth rate. Right. So you can apply the geometric average and get the average growth rate. Right. Then you can use the dividend growth model to calculate the intrinsic value. Right. Right. So you can do the assignment. Right. So that assignment is much easier. But there are questions you have to study and answer. Right. So I have given a little guidance on the calculation part. Right. Now we'll move on to our next lesson, risk and return. Risk and return. So we have some time to discuss about risk and return. Right. Now there are two concepts, return and risk. Right. So return is the financial benefit from your investment. Simple meaning is the financial benefit from your investment. For example, if you invest in debentures, what are your financial benefits?
Dividends.
For debentures? Debentures?
Yeah, interest rate. Right?
Interest. So one benefit is coupon, interest. Another benefit is if it is traded in a market, you can sell it.
So redemption.
Yes. Before the redemption, you can sell it if it is traded in a market, like stock market. There are market for debentures. But in Sri Lanka, we don't have. Right. So if it is traded in a market, you can sell your debentures and make profits. We call it capital gain. So for example, let's say, now you very carefully go through these examples, right? Let's say you have invested AB company's debentures. Nominal value 1,000. Coupon rate 10%. Let's say you invested now. Let's say you invested now for a price of 950. After 1 year's time, You sold debentures for a price of 1,050. You invested now for a price of 950. After 1 year's time, you sold them at a price of 1,050. During the year, you have received you got the interest coupon. How much coupon during the year? How much your coupon during the year?
100, sir.
95.
100. Yes. 1,000 is nominal value. 10%.
100.
Coupon 100.
Yes.
Coupon 100. Then how much your total return?
200, sir. Because
Yes,
when we
200.
Yeah.
Yes, very good. 200. Return is coupon plus the capital gain. So coupon is 100. Capital gain, you bought it at 950, sold at 1,050. So capital gain is the profit from sale of your debenture. So gain, you see, gain is 100. Then total return 200. Total return 200. Now let's say another example. You invested XY PLC equity shares. You invested XY PLC's equity shares. Let's say you invested now. Now you invested. So invested means you bought shares of this company at a price of 10. After 1 year's time, you sold them at the price of 13. You sold these shares at the price of 13. During the year, let's say you received dividend. You received dividend. Dividend of rupees, let's say dividend of rupees 2 per share. How much your total return?
5.
Yes, 5. So here return is dividend plus capital gain.
capital gain.
Dividend plus capital gain. Now earlier one is about debentures. Then not dividend, coupon.
Yeah.
But here stocks, equity shares. Then dividend plus capital gain. Dividend 2, capital gain, you see, you bought at 10, sold at 13. So gain is 3. So total return is 5. 5 per share. So this is your financial benefit from the investment. Financial benefit from the investment. Right. So this return, you can give as a rate of return, as a percentage. We call it rate of return. So this is amount of return, the value of return. You can express it as rate of return. Rate of return. So rate of return is the total return divided by the investment. You see, you got 5 in this example. total return 5. How much your investment? How much your investment?
10.
10. You see, you bought shares at 10. Then how much rate of return?
0.5.
Yes. As a percentage, 50%. As a percentage, 50%. In the previous example, how much is the rate of return? You see previous example, return 200. How much rate of return? Return is 200. How much is the rate of return? Rate of return? How much? Return 200. How much is the investment? 950, you see? You bought debentures at 950.
20%, sir.
How
0.2.
much? 200 divided by 950. Yes. 0.21. 21 as a percentage? 21%. Yes, 21%. So your financial benefit, you can give as a rate. We can say rate of return. Rate of return. Right. So especially for equity shares, this rate of return vary from year to year. Why is that? Why is that? Especially for equity shares.
Because, sir, I think when we got enough money, only we'll get the returns, right? So it will be vary, right?
Yes, but what is the basic reason?
Yes, the interest. You get an interest also.
Yes. The basic reason is, now for equity shares, you get dividend. Will that be same for all the years you do investment?
No.
No. Dividend vary from year to year. Capital gain also vary because share price is changing. Right? The price per share is changing every time. Right? Sometimes today you buy shares and sell for 20 in the next year, in 6 months time. But after that, share price may further increase. So capital gain also vary. So especially for equity shares, the rate of return vary from year to year. Rate of return vary from year to year. Now let's take simple example. Now assume you bought shares of a particular company. Now you carefully look at this example. Assume you bought shares of a particular company about 5 years back. Right. About 5 years back. Let's say these are the dividend you received during the last 5 years. Last 5 years. Let's take last 5 years. 2019, 20, 21, 22, 23. So let's assume these are the dividend you got during the last 5 years. 19 dividend of 2, 20 dividend of 250, 230, 245, let's say 240, and 220. Let's say a share price at the end of each year. Let's say you invested in these shares at 10 per share. Invested at before 5 years, 10 per share. At the end of 2019, share price is, let's say, 11. 2020 share price is 12. 2021 share price is 1250. 2022 share price is 13. 23 share price is 1320. Right. Now calculate your total return each year. You calculate your total return each year. How much your total return each year? Each of the last 5 years.
First year 3.
Yes, first year 3. How do you get 3? Dividend 2 plus how much your capital gain? You invested at 10. Sorry. You invested at 10.
10, but now it's 11.
Yes, end of the first year 11. If you sold the shares end of the first year, your capital gain would be 1. Then total return, dividend
3.
2, capital gain 1, total return 3. Then 2020, how much?
4.5.
250 plus how much capital gain?
2.
Not 2. During the year 2020, how much share price increase?
Just 1 rupees, sir. 1.
1.
11 increased to 12.
Then 3.
So capital gain 1. Then total return 250 plus 1, 350. 350. Now calculate rate of return. Rate of return. How much first year rate of return? How much is the first year rate of return? How much is the first year rate of return? Total
0.3.
return 3. Yes. Total return 3 divided by beginning price 10. 0.3 or 30%. 0.3. Or you can say 30%. 0.3 or 30%. Second year, how much? Total return 350 divided by beginning price. So beginning of the year price. Now how much beginning of the year price? Not the initial investment.
11.
So we are calculating the return for 2020. The total return in the 2020, 350 divided by price at the beginning of that year, 11. You see, price at the beginning of that year, end of 2019 means beginning of 2020. 11. How much? How much?
0.35.
Yes, 350 divided by 11. How much? Point
0.31, right?
yes. 32.
Okay.
0.32. Then 32%. How about total return in 2021? Dividend 230. Capital gain
280.
how much? Yes. Capital gain 50 cents. Then total return 280. Rate of return 280 divided by price at the beginning of that year. 12. How much? 280 divided by 12.
0.23.
How
sir.
much? Yes.
0.23.
0.23.
0.2.
3%. Now you see, rate of return change from year to year. You see 2022. You see 2022.
2.9 total rate.
Yes. Capital gain 50 cents. Then total return 290. Rate of return 290 divided by price at the beginning of that year. 1250. Price at the beginning of that year, 1250.
0.232, sir.
Yes. How much?
0.23.
Yes, 232. 232. Almost 23%. Now you see, rate of return change from year to year. You see, rate of return vary from year to year. You see, rate of return vary from year to year. So this variability of rate of return is risk. We call risk. Variability of rate of return, we call risk. So that is the meaning of risk. So risk is variability of rate of return. Variability in the rate of return. Have you got the idea?
Yes, sir. Perfect. Yes. Very good. Clearly, we got.
Right. Variability in the rate of return. So there are measures to estimate the risk. So one measure is, so risk you can estimate using variance and standard deviation. Right. Now you have the idea. Risk is the variability of rate of return. So with that example, we have seen rate of return vary. So you can measure risk by using variance and standard deviation. So variance is indicated by sigma squared. Standard deviation is sigma. Right. Now let's see how do you calculate sigma squared and sigma. Right. So let's take very simple example. Right. So let's say these are the rate of return over the last 5 years. Sorry, we'll take last 4 years. The last 4 years, 2020, 21, 22, and 23. Let's say rate of return. So rate of return we go give by R. R. R is the rate of return. Let's say 2020 rate of return 10%. 2021 13%. 2022 12%. 2023 14%. So let's say these are the rate of return. So these are calculated like this. You get the total return. Then you can get the rate of return. Now let's say for your investment, last 4 years you got this rate of return. Now you see this rate of return is varying. It was varying over the last 4 years. So what does it mean? Last 4 years,
There is a
your
risk.
Risk rate is increasing.
very good. You see, for your investment last 4 years, rate of return was changed, varying. The meaning is there was a risk involved. Risk was involved in your investment. Now you should estimate the risk. So once you know that there was a risk involved, in my investment, you have to estimate it. You have to estimate it. So you can you hear me now?
Yes, sir.
Yes. Audible.
So one moment, please. Right. Now you say your investment involve risk because rate of return changed. Now you should estimate the risk. So you can calculate the variance and standard deviation. Right. So let's see the variance calculation. Now first get the average return. You first get the average return. Average return. So how do you get the average return? You first get the average return. So how do you get the average return? Get the total of returns divided by 4. How much? Average return. How much? Take the total divided by 4. Now calculate and see how much. Average return.
0.12.
0.12. Is it 0.12? How about others?
Yes.
So 0.949, sir.
Average return.
That's the
Total
total.
is, yes, 0.49 total divided by 4. Average return 0.12.
Yes,
Let's
sir.
say 0.12.
Yes, sir.
Right. So let's take it as R bar, average return. R bar. Right. So you have to get the average return. Then from each R, deduct the average return. From each return, you deduct the average return. So in the 2020, return is 10%. Average return 0.12. How much? Minus 0.02. From each return, you deduct the average return. 2021, return is 0.13. Average return 0.12. Then
0.0.
0.1. Next year, 0.12.
0.
minus, yes, 0.
0.
Then following year,
0.02.
right? From each R, now you see you deducted the average return. Now you see there are negative values. You see for 2020, the difference is negative. So when you calculate the variance, that negative value should also be considered. Now to avoid the negative sign, you take the squared return, R minus R bar to the power 2. Right, R minus R bar to the power 2. How much? 2020, R minus R bar to the power 2. R minus R bar 0.02 to the power 2. How much? 0.02 to the power 2. How much? 0.0004. Have you got it?
Yes, sir.
Okay, yeah.
Then next year, 0.1 to the power 2. 0.0001. Have you got it?
Yes, sir.
Then 0. Then 0.004. Right. So variance is the total of these squared return, total of these squared deviations. Now you see, this is, now the first part is deviation of return from the average. R minus R bar is deviation of rate of return from the average. Then squared deviations. Now take the total squared deviations. You take the total of the squared deviations. How much total?
0.000.
Yes, 0.009. Right. So variance is, variance is, you take the total of squared deviations, sigma R minus R bar squared. Now what is that? Squared deviations total. Squared deviations total. Divided by n minus 1. So that is variance. How much? Squared deviations total 0009. N minus 1. N is the number of years, 4 years. 4 minus 1, 3. Then how much variance? How much variance?
0.003.
Yes. Variance 0.0003. Now you see again the calculation. You got the total of, first you got the deviation of return from the average. You see, you got the deviation of rate of return from the average. Then you got squared deviation and total of the squared deviation. This total divided by total of squared deviations divided by n minus 1. So that is the variance. Right. Then standard deviation is sigma. You see, variance is sigma squared. Standard deviation is sigma. So sigma equal square root of the variance. How much? Square root of the variance? How much? Square root of the variance?
0.03.
0.0173.
No, square root. Square root. 0.055. Have you got it? Square root. Square root of the variance value. Square root of the variance value. Have you got the answer? Have you got the answer? 0.055.
No. So I got 0.01.
Yes. Yes. Yes.
0.01.
Sorry.
Yes. That's why I
Yes.
was wondering.
0.17. Is that correct? 17?
Yes, sir.
Yes. Oh, you can make it as a percentage. 1.7%. Standard deviation. Right. So variability of rate of return is 1.7%. Variability of rate of return is 1.7%. Right. Now this is based on past return. Right. Now you see, we analyze the past return. So you got the variability or standard deviation, that is the risk. So you measure the risk. Now you see very carefully. Based on the past return. Based on the past return. But there are situations you predict future return. Right? Now we estimated the risk based on the past return. There are situations you have predictions about future. We call expected return. Expected return. ER. Expected return. So usually you make expectations with probabilities. Now listen to me very carefully. You make predictions with probabilities. So when you make expected returns, you have the relevant probabilities. So you have expected return with probabilities. So these are predictions about the future. Now, for example, if the economic crisis continues, now you have predictions about the economic crisis. Let's say this economic crisis will continue for the next year. So there's a, let's say, 70% chance. There's a 70% chance, for example, probability 70%, that the economic is in crisis situation, recession. in the next year. There's a 1% chance, 10% chance that the economic, there will be economic growth in the next year. There's a 20% chance let's say economic will become stable. Economy will become stable in the next year. So if the economic crisis is in recession, let's say you expect 8% rate of return for your investment. If the economy would grow in the next year, you expect 15% rate of return for your investment. If the economy becomes stable, you expect, let's say, 10% rate of return for your investment. Now, you see, these are predictions about the rate of return. We call expected return. Now, you see, when you predict return, there should be associated probability. Now, when you have expected return, you have the associated probability. So when you predict return, there's an associated probability. Right. Now you see early, we have last 5 years rate of return. Now you see early question, we have last 4 years rate of return. Do you need a probability? Do you need a probability for that?
No.
No, because these returns you have already got. You have already received them. They are sure. You receive 2020 10% return. It is not uncertain. You have received that. 2021 you receive 13% return. You have received that. But future returns are uncertain. Then there should be associated probability. There should be associated probability. Now, how do you get the expected return? This rate of return multiplied by the probability. You get the expected return. Right. So previously we calculated the average return. You can remember. You got the total of the returns divided by number of years. But here we get the expected return. So each return multiplied by the probability. How much? 0.7 into 8%. How much? You multiply by the probability?
0.026.
Yes, 56. Next one, 0.015. Sorry. Yes, 0.015. After that, 0.02. Then the total of these we call expected return. How much? Expected return?
0.073.
How much? Is it 0.091? Have you got this answer?
Yes, sir.
0.091. 0.091.
Yes.
Right. So approximately you can say 0.09. Have you got it?
Yes, sir.
Yes.
Right. So that's expected return. So next year you expect from this investment 9% return. 9% return. Right? Right. So I'm going to take another 5 minutes and I'll explain how to calculate the variance and standard deviation in this situation. Right. So let's take another 5 minutes. Now, earlier we got variance and standard deviation using the past return. Now we are applying the future return, expected return. The calculation is more or less same, but little difference. Right. Right. Now we have rate of return with probabilities and expected return. Right. So we have rate of return. Now work out the question with me, then you can understand. We have rate of return under 3 situations: recession, economic growth, and when the economy is stable. How much rate of return? How much R value? 0.08.
Yeah. 0.1.
0.15 and 0.1. Now you see earlier how you started calculating the variance. Earlier, you see each rate of return. Now what is the first step? Each rate of return minus, you see what is the first step? Each rate of return minus R bar. What is R bar? What is R bar?
Average return.
Average return. Very good. Average return. Here also the same. But instead of average return, we have expected return. Then how do you calculate? Each rate of return minus, not R bar now, each rate of return minus expected return. So instead of average, we have expected return. Now each rate of return minus expected return. How much? 0.08 minus 0.09. How much? Expected return 0.09. How much? Minus 0.01. Then 0.0515 minus 0.09. How much? 0.06. Have you got it? Have you got it? How much next one? 0.1 minus 0.09. How much? 0.01. Now you see earlier in the variance calculation, we started with R minus average return. Now here also the same. But here instead of average return, we apply expected return. So that is the first step. Then what is the next step? We got the squared value. We got the squared value. So here also we get the squared value. R minus R expected return to the power 2. We get the squared value. How much? Squared value of this 0.01 to the power 2. How much? How much? 0.001. Have you got it? Then
Yes.
0.06. Yes. 0.06 to the power 2. How much? 0036. How much? 0.001. Have you got the answers?
Yes.
Right. That is the second step. Then what is the third step? You got the total and divided by n minus 1. So that is for the variance calculation when you are using past data. But here what we do is, so this is multiplied by probability. So these squared deviations are multiplied by probability. So what are the probabilities? 0.7, 0.1, and 0.2. So these squared deviations are multiplied by probability. How much? 0.001 multiplied by 0.7. How much? 0.407. 0.0036 multiplied by 0.1. 0.0036. How much? Next one? 0.402. Then get the total. Get the total. Sigma. Total. That is the variance. That is the variance. How much? Total?
0.00045.
Yes. Point 0.00043.
Sir.
Is it 43?
Yes, sir. Yeah.
Right. So that is the variance. Then how do you get the standard deviation? Same as earlier one. Square root of the variance. So you get the square root of the variance. 0.00043. How much?
0.021.
Yes. 0.021. As a percentage, 2.1%. Right. 2.1%. Right. So you can practice. Similar questions are given in the course material. You can practice. Right. So this is the end of today's discussion. So I didn't have time to discuss the risk and return for a portfolio. Right. So we discuss all the sessions except this in the unit 1. Right. So let's see whether we have time in the next session, next day school. Right. Because we have very limited time, 3 hours. Right. Right. Then let's meet in the next time.
Okay.
Right.
Thank you, sir.
So we
Thank
don't
you
know
so
whether, yes. We don't know whether we would have the